All right, so welcome back. The last thing that I wanted to talk about was how much depreciation is taken based on what method we use. So I'm going to make a little chart to kind of show you. So we're going to basically compare how the double declining method of depreciation and the straight line compare to each other. So our x-axis here is going to be time in years, and then our y-axis is going to be depreciation. So for the straight line, let's make it a green line, I guess. Um, so it's straight line. So over the course of its useful life, we're just gonna take the same amount every year. And now the double declining, in the beginning of the asset's useful life, we're gonna take more depreciation, and then we're slowly gonna decrease the amount of depreciation every year until we're actually taking more or less depreciation than the straight line near the end of the double declining method's life. And now the activity method. The activity method is kind of weird, and then it can like bounce around every year, you know what I mean? It just all depends on how much activity you're using it. So this is the activity method, is the purple line. The green line is straight line, and the yellow line is the double declining. So now with knowing this, I'd also know like questions kind of like number 3 over here, in that knowing like, okay, so in the beginning, the double declining method is going to give you more depreciation, which means, you're going to have less income in the beginning periods. And in the ending periods, you're going to have less depreciation, but you're going to have, you're going to have more net income at the end. But also keep in mind that over this period, we're depreciating the same amount over the life of the asset. It's just the amount every year is going to change. So on top of what I've talked about here, I'd also look at the conceptual stuff in your chapter 9 packet, and also practice like capitalizing, knowing like what costs to capitalize. So a problem that I've always kind of seen is like, you'll have like costs of like transportation costs, which of course are capitalized, and like insurance for transportation. So I'll just make a little list here. So insurance, transportation, and the one they always try and get you with is they'll say like the estimated amount of extra electricity to run the equipment is going to be blah blah blah. That is not capitalized because it's only like 1 year, and it's hard to associate with one piece of equipment. And you'll talk about more about that kind of stuff in 249. And another thing that they try and get you with is they'll say like the salary of a person running the machine is 50,000 a year. You don't capitalize that because it's not a one-time cost. You're going to pay that person every year. So again, you can't associate that with the equipment. Now, if it said like a one-time training thing of like 20,000, then that would be capitalized. So I remember that, and then kind of like another thing in the chapter 9 packet was capital, knowing which costs, including like the building and like building or land improvements and land. It's kind of a hard one. If you have any questions on like why something goes with what, don't be afraid to reach out. And yeah, just go through that and make sure with through like these problems, know like, when you do the depreciation every year, it's a depreciation expense and accumulated depreciation, which is a contra asset. So it decreases assets, and you're decreasing depreciation, or you're increasing depreciation, which is decreasing retained earnings. So keep that in mind, and you should be good on chapter 9 stuff, and chapter 10, 11, and 12 to follow shortly.